Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. We've turned another day on the calendar. It is 2023. And at the Old Capital Podcast, we are going to have Mr. Michael Becker, the governor of the great state of Texas and the real estate division of the great state.
Hey,
Michael,
Paul.
how are you?
Good. Just getting back in the swing of things. How you doing?
Doing great. And also we have the professor, Mr. James Zhang. James, how are you?
Good, Paul. Thanks for having me on.
We're getting about halfway through the month of January, so we were due to have this kind of a talk of, let's look backwards on 2022 and let's kind of like look forwards in 2023. And so our discussion today is what we see, what's happening with the market itself. And Michael, who has closed, Michael, how many units have your group over at SPI over the years? How many units have you purchased?
Somewhere around 14,000, give or take, maybe a little more.
All right. Some great information from an operator and multifamily. And then James, the Old Capital team, how much did you close just last year?
Yeah, we're still tallying it up, but probably over 1.2 billion. So it's about 13 or 14,000 units that we financed last year. So pretty busy year.
Both of you guys have had was a great year in 2022. And in 2022, the beginning of 2022, we were thinking we were probably going to do $2 or $3 billion worth of financing because the energy was so hot coming in out of 2021, going into 2022. So, Mike, can you just kind of give us a little bit of your impression of coming into 2022, what that was like, and then kind of work us through the rest of the year?
Yeah, kind of going into the year, everything was pretty white hot. I mean, you had a ton of activity kind of finishing up 21. Q4 21 was a monster from a activity standpoint. I know everyone on this call here was super busy. The rest of the market was too. And then kind of started off the year. There was a little bit of a low in inventory to kind of start the year off because a lot of the deals got brought forward into 21. There was some, if you recall, some discussion around changing the capital gains tax and et cetera. So I got a lot of deals kind of brought in there. And then the deals that kind of did hit the market, right after the first of the year went absolutely crazy, tons of bidders, not much inventory. So the price just, went kind of parabolic on them. Very aggressive terms from buyers, multiple bidders. And that was probably all the way through, say, February. And then kind of getting into March, things started changing real quick. March was the first rate hike from the Fed, and you started seeing the capital markets deteriorate, Paul, and making some of these deals not pencil as well as the interest rates started rising. And then kind of as we went throughout the year, got worse by the day, seemingly, from a mainly capital markets driven scenario. We still got quite a few deals done, but they became harder and harder as you kind of went throughout the year. We had a little bit of a reprieve kind of in that July, August timeframe where interest rates kind of came back in, lending was okay, and then they popped right back up come late August into September. So as we finished the year, I think it was disappointing relative to expectations kind of going into it. Largely capital markets were the problem, and it really took a lot of inventory that otherwise would have sold, didn't trade. There's, as we kind of finished up 22 and where we are today, there's a pretty good bid-ask spread between what the sellers want to get and what the buyers are willing to pay. And that's kind of the gulf in the marketplace right now.
Yep, absolutely makes sense. James, you and I were down in Orlando about this time last year. It was at the National Multifamily Housing Conference. And what was the feeling down in Orlando for all buyers and all capital markets guys, which is really like loan officers and debt providers and equity people? Tell me what it was like.
Buy everything and we can finance it at 3%. The Fed kept saying that they were going to raise rates. No one believed them. And so in January of last year, your all-in rate going in on a lot of these deals on bridge were 3% or 3.25. And so you could pay a 4 cap on all these deals and they still worked. And so, when you go to a seller or a current owner and say, hey, we'll pay you a 4% cap rate on your deal that you bought on an 8% cap rate, you look like a genius. So everybody was a seller. And so brokers had tons of deals that were ready to go, at 4.5 caps, and they went. And so, the beginning of this year was huge. I think we were on pace to beat 2021 across the board in terms of every metric. And so the second half of the year, I think, was really telling when 10-year treasury went from, let's say, 1.5 to 3.5 to 4%. And then your, SOFR on your front end of the curve went from 0 to 4. And so it just completely changed the dynamic for people trying to finance these deals. And people were having a little bit more trouble on leasing units and raising rents. And so just sort of the combination of those two things, higher rates and then more inflation on the expense side, and less pushing on the rents. And so just put the brakes on in terms of transaction activity.
Absolutely. It went from being nice and warm and sunny in Orlando to feeling a freeze or a frost in the middle of the year, that it got pretty damn chilly, because with interest rates going up, people were making economic decisions to not really go forward. A lot of the institutional buyers were pencils down, which I think followed through with a lot of folks, that they were pencils down of not buying multifamily properties. But as they say, that was then, here is now. And before we start talking about 2023, people have been searching for a lot of information about getting into multifamily, investing in multifamily, staying in multifamily. And James, if you can just tell everybody write this down, because we have 2 speaker series that are coming up here, one in February and one in March. And so you want to be at these speaker series. Again, they're in Dallas, in the Dallas-Fort Worth area. James, can you kind of give us a little idea about who's going to be there?
Yeah. So the first one is Monday, February 13th. Greg Willett. So he runs really the market side for IPA, which is one of the larger brokerage houses that's affiliated with Marcus & Millichap. So he'll be in to talk really about the major Texas markets. And then on March 22nd, which is the second meeting for the Fed this year, we're bringing in JP Conklin with Pensford. So he's been at numerous events for us and one of the best in that space. So I would mark your calendar for Monday, February 13th and Wednesday, March 22nd. If you're not on our email list, that'd probably be the best way. We'll send out a link on that and put it on the Old Capital Podcast website as well.
There's usually 300 or 400 people that are multifamily investors that attend those type of events, and you want to be part of that networking and information gathering presentation from both Greg Willett and JP Conklin with Pensford. So contact Old Capital to try to get on our list if you're not on our list currently. All right. As I said, that was then, this is now. We are all going to go to the National Multifamily Conference at the end of the month in January. Again, that's a big conference. There'll be 8,000 or 9,000 investors that go to the conference every year for the last like 10 or 12 years. It's been between Orlando and San Diego. This year it's going to be in Las Vegas. And so this is I think it's a 5-year contract that they have to do the National Multifamily Housing Conference in Las Vegas. And James, what goes into this conference? And is it worthwhile for just the average Joe to attend, or who attends that event?
It feels like everybody, but it's really, I think players on the national scale, if you're a buyer out of California and you're investing in Texas and Atlanta and Phoenix, all the brokers are there. And so you're able to just set meetings with all of them and just sort of in 2 days, meet every broker that you want to know. I think guys who are focused in on maybe one market, that might be a little bit harder to come out. But I mean, it's a good time. There's a ton of lenders, brokers, owners, all there. And it really gives you a sense of the market, where it's at today, and just get to talk to a lot of people in a very intimate casino setting.
And Mike, you're an operator of thousands of units. Why do you go to the National Multifamily Housing Council meeting?
Yeah, a ton of people, a lot of informal, impromptu meetings for me. I don't necessarily do a whole ton of formal stuff anymore. But yeah, for me, probably more FOMO, right? If I didn't go, I feel like I'm missing out. Everyone else is having all the fun and kind of right up my alley, and you get to, mix and mingle. And hopefully the goal every year is to come out of there with a deal. either you're selling something or buying something or both, or maybe some sort of new contact that can maybe help you do some business. So, brokers, equity, apartment owners, vendors, banks, title companies, I mean, brokers, all of it, all of them are out there in one location. And you throw Vegas in the mix, we'll see kind of how that all plays out. So anyone going, I probably wouldn't book anything before lunch for meetings, or you have a high probability of getting it canceled.
I would think so. I don't think we'll see how Las Vegas does for a bunch of guys and gals to try to keep their meetings straight. So let's talk about 2023 and a little bit about what our take is going into this year. We get the capital markets guy with James, the operators guy with Mike. Let's kind of go through just, Mike, what your prognostication for 2023.
Yeah, right now it seems like it's kind of slow out of the gate. There's not a ton of inventory. We're seeing some stuff come out. Blackstone's got their B REIT that had a big redemption problems. I think you kind of saw the B REIT and the S REIT for Starwood having a redemption issue. So there's several Blackstone deals you kind of seen on the market, which I think is 100% correlated to the redemption issues they had. Those tend to be a little bigger, nicer ones. Haven't seen a ton of the workforce housing. Maybe you guys see it and I just haven't seen it, but I haven't seen a ton of workforce housing relative to kind of, this time last, handful of years. Seems like the volume's, quite a bit off. And I think that'll probably be pretty limited volume in the workforce housing in the first part of the year, just because, again, I think there's a pretty decent bid-ask spread where, sellers, want or feel like they need to get a certain pricing and the market can't pay that pricing with the debt terms out there. So everyone's kind of, buyers aren't willing to pay what the sellers feel like they need to get out of it. So until someone really blinks and the market kind of recalibrates, that's where I think we're at. That's kind of what we're seeing. It seems like inflation is starting to roll over too, where we just had a recent CPI print last week as we record it. So it seems like inflation is starting to cool off, and it seems like consensus is a 25 basis point hike in February from the Federal Reserve, not 50 like in December. So I think we're kind of getting towards the near the end of all the hiking cycle, and then they're on the clock for a cut. So we'll see how long that takes to get the first cut. But seems like most of the pain, is largely behind us. The question is, can you wait it out until the rates come back in or rents kind of start growing? And how bad is this, seemingly impending recession going to be? Is it going to be kind of a garden variety thing, or is it going to be something a little bit more serious? And how does that impact rent? So I think all those are kind of up in the air, where it seems like it's causing activity to be a little less, just because everyone's a little bit uncertain right now. Paul?
James, what do you think the first couple of months of 2023?
Yeah, I mean, I was trying to read a bunch of stuff the last couple of weeks, just trying to get a feel for what people are thinking. And the thing that I saw across the board was really, when does the Fed pause? And once the Fed pauses, it signals a couple things. One is inflation's coming down, right? So a couple more prints of, 6, the 5, the 4 on CPI. So inflation cools. That sort of relieves the pressure for people who are on floating rate debt. If you don't have a cap, you're seeing that crank up every month on your monthly payment. And then also your interest rate cap cost will come down, right? So a lot of times the interest rate cap costs, they're made up of uncertainty and also just the cost of actually paying you out. And so right now, once the Fed pauses, we've seen cap costs come down, and that's going to help new deals. And it's also going to help at monthly escrows that people are putting up. And then, like Mike said, they're on the clock, right? So usually after a pause, 9 months on average, we see a rate cut. And so the last thing is also the 10-year treasury, right? So 10-year treasuries actually come in a little bit. So it's hanging around 3.5 right now. So add 200 basis points, you're at 550, which isn't bad compared to, 650, which is what some people were seeing sort of end of last year. And so 10-year treasury starts making its way down from 3.5 to 3 to 2.5. And that makes it a lot easier to get out of these deals. And so that to me is like the number one signal right now, is once the Fed pauses, all those things start becoming a lot easier, because, there's definitely some challenges on the property level, but a lot of the challenges, I think, for 2023 for operators is going to be people with sort of forced maturities or negative cash flow. And the forced maturities are going to be, your short-term bridges. And then the negative cash flow could be from, your monthly escrows or just your debt service costs just going too high on you. And so figuring out the hashtag that I've been seeing is survive to 25. And so a lot of people
I like that one.
So I think this harkens back to, I guess, the savings loans crisis. People were just like survive to 95. So I think a lot of the stuff sort of got pushed through the system and had to clear the system. And so I think, even some of the larger, I think there was a couple of things that I read, just like larger operators, maybe in California, who have bridge loans, they started just letting, I don't know if they're in default, but basically they're seeing some delinquency rise up on some of these floating rate loans on larger portfolios. And so some of that's going to just have to go through the system, and those prices are going to be low. And so you're going to have to deal with that over the next year or so. And you just don't want to have to sell at that point in time.
I think a lot of partnerships are not a lot of partnerships, but a number of partnerships, people that did bridge loans back in 2000 and say 20, 21 or so, 22, it started to be uncovered. But remember, you can make a lot of money in real estate if you have long-term maturities. But if you have short-term maturities and you have to react or act during a period of time that you think you're going to be able to sell and the market is not favorable for you to sell, interest rates go up, inflation goes up, you may be put into a position or a box that may not be so good. So let's kind of talk a little bit about winning the battle, Mike, and also winning the war. I mean, how are you seeing right now as an operator? Rents, are they still going up? What's occupancy these days? I mean, tell us a little bit on the perspective as an operator of what's going on.
Yeah, we own nicer kind of A minus stuff, basically is almost exclusively what we own anymore. So we don't own a lot of the workforce housing, and we don't own lesser locations. So we own Dallas, Austin, Houston. So everything's obviously very localized. But from my view of the world, I mean, occupancy still pretty strong. I mean, we're seasonally coming out of the slowest part of the year. So November, December are your two slowest months from a leasing traffic, just with the holidays and bad weather. And once you get in January, traffic kind of picks up, and it really starts picking up in, March and in Texas in particular. So, I mean, seasonally, we're kind of about where we should be, kind of that 94-ish plus minus occupancy fall across the portfolio, some higher, some lower. Rents, we're still seeing positive trade outs. Obviously, we're not seeing the growth that we saw back at the beginning of the year. I mean, beginning of the year, even into the summer, I mean, we're seeing, kind of low teens on renewal on percentage trade outs, and, high teens on the new lease trade outs. And that was, abnormal. A normal year, you're hoping to get, 3, maybe 4%. So, I mean, over the last, 2 years, we, basically every year we're seeing 4 to 5 years worth of rent growth in a year, which is, atypical. So obviously that's decelerated. So there's been some disinflation. I don't think there's been deflation yet, but disinflation with the rate of change of the rental rate growth. Now, as we go into 23, maybe that changes. Maybe we do see some, negative trade outs and see some lower rents. I haven't really seen that in our portfolio yet. Wouldn't shock me if a deal or two has some negative rents at some point. But overall, occupancy, lease trade outs are all still pretty healthy. It's kind of more of a normalized market. I mean, it certainly has slowed down a little bit, but I think, part of that could be, we didn't really have a season in 21 going into 22. And now we kind of do have a normal seasonality that you have in multifamily in December. So if we get into April and May and we're not seeing the demand pick back up, then that would be a little more concerning than, in say December when traffic is a little slower at Christmas.
How about NOI? Are you seeing NOI flat, go up a little bit, go down a little bit? What's your 2 cents on that?
Generally still going up. I mean, you're having, revenues still marching higher, generally speaking, across the board. I mean, we've been having expense pressures for years, which the tremendous rental rate growth more than kind of outstripped last, couple of years. So I think that's really, if you're circling a part of your income statement where you want to be a little more concerned about, I mean, is, taxes have gotten hit, and we'll see if they hit us again as we go into the April notices in Texas. How does that work? I'm hopeful, and I think the base cases probably won't be quite as aggressive as they have been the last couple of years, just with the cap rates kind of expanding a little bit. But insurance has certainly been a problem, and that doesn't see any signs of letting up with the hurricane in Florida that did a bunch of damage, and this and that. It seems like those costs have certainly been tough. I think we're seeing some of the supply chain issues ease up, so you can get appliances and refrigerators now, where a year ago it was really hard to find, just anything to turn a unit over. It was a little bit tougher. So I think you're seeing some of those material costs come in a little bit, and then labor costs keep going up as well. So those are where your pressures are largely. I think you're seeing some of the material stuff come in. Insurance is still problematic, especially in the workforce housing. We did our first 70s deal in 7 years, Paul, in December, and I think our insurance bill was $600 something a door, which I think was a pretty good relative price per door. And I think the last time we had a 70s deal, it was like sub 300 a unit or something like that. And insurance costs over the last 5-6 years, it more than doubled the insurance cost, which was a little bit shocking to me, to kind of put a little context to it. And hearing some of these other deals, depending on location or physical condition of the construction quality, sometimes these insurance bills are pushing $1,000 a unit for some of these 60s, 70s finished deals, which when we first got into business a decade ago, that was $200. So it's that's certainly been a real problem and is impacting NOI a little bit.
I'll just tell you a quick story. A buddy of mine's son is down this weekend, and he just got a job over at Texas Instruments. So he's an engineer, not young guy, 22 years old, about to graduate. And I had him out looking at some properties over in the Knox Henderson area, over in SMU area, then all the way up to where their offices are up in the City Line area, up in 75. And so there's one thing about us being in the business of actually talking about where rents are, but when walking some of these units and seeing what the prices are on some of these units, $1,795, $2,000, $2,200 for a 1-bedroom, Class A minus A building, it really kind of hits home that these numbers are just huge these days, and that not entirely shocking because I'm in the business, but just how much people have to make to be able to afford some of these numbers. And you go to some different states, their rents are up huge too. And then they have state income tax on top of that too. So just kind of amazing numbers where rents are and where they've gone to since I got in the business back 35 plus years ago to where they are today when you just take a look at it. So there's no doubt that labor costs are just huge around the board, especially affecting the multifamily business, maintenance and marketing people and the people that are inside the clubhouse trying to rent your units. James, what's your 2 cents right now in say NOI and sales? Are you seeing a lot of sales going on, and how are these deals getting financed?
Yeah, I mean, in terms of sales right now, I mean, it's really, back in, let's say a year ago, it was, list the deal, have 50 buyers, narrow down to 10, best and final, the best and final, the best and final. And then, we pick one guy and then off we went and he got new debt. Right now, it's more who's in trouble and maybe that person needs a call and they need to be rescued. So those deals are coming. We haven't seen a ton of those deals. I mean, there's a couple deals where, the seller bought the deal a year ago and he's on a bridge and he doesn't have a rate cap and he's selling it now. There's, a couple of those, but a lot of the deals are, maybe the guy bought the deal 5 years ago and he was going to sell it last year or the year before. And he just didn't hit the timing exactly right to get to the top of the market. But, they've been in the deal 5 or 6 years and they don't want to stay in this deal for another 4 or 5 years. And so they're selling the deal maybe on a loan assumption. We're seeing a couple of those go through right now. Or, some of these people are just like, look, the equity wants out, but me as a general partner, I still like the deal and it's better than anything else out there. So we'll just recap the deal as well. And so we're doing some recaps, we're doing some refis, we're doing some loan assumptions. So it's really a mixed bag of stuff. It's not just probably last year, 75% of what we did was non-recourse bridge. And so that was pretty much every deal was new debt, non-recourse bridge, and off we went. So this year is a little bit of a hodgepodge of things. And I think trying to figure out what to do on some of these deals is why people call us, to figure out, where Fannie is, where Freddie is. And then if I do need a bridge, how expensive is it going to be?
Yeah, not 31 flavors of ice cream, but maybe 15 or 16 different ways of getting transactions financed these days. So talk with the old capital team to see if they can help you out, whether it's an assumption or it's new debt, or just even talking through how these deals are going to be put together. Because I think that's going to be critical in the future, is making sure that you have the right debt in place to survive the initial battle that's going to be going on here in the next 6 months to a year. Mike, what's kind of your game plan for 2023? Are you buying stuff, selling stuff? What's kind of your game plan?
We had a pretty busy kind of end of the year, which I think is why we have been on the podcast in a minute. So we had a bunch of stuff going and some travel. We bought a deal and sold two like the last 2 weeks of the year, as well as we have two in escrow that one should close into this month and one will close mid-February. We'll have two 1031s we've got to go place. Of those four sales, two we're trying to do 1031s on. So we got those trying to get put together right now as we speak. So kind of working through those. And then I think generally speaking, we're trying to be more net buyer than net seller. I think we're almost a 3-to-1 net seller last year. Sold, 3 for every one that we bought, which turned out to be fortunate. It's just the way the world worked last year. But I think, generally speaking, that's kind of disappointing in a certain respect, where we're trying to grow our assets under management, grow our unit count, and try to march to about 10,000 in the portfolio. And we started over 7,000 last year, and we ended around 6,000 or maybe a little less, 6,000 units in the portfolio as we finished the year out. So we're trying to grow a little bit. So I think for my view of the world, I think there's first half of the year, I think the groups that are probably more likely to take reality are the developers. So buying some newer stuff from developers that are on a construction loan that they set their cost a few years ago and they got to get out of the deal. I think they're a little bit more pragmatic. I think to kind of what James was talking about, I think the second half of the year is probably when reality sets in on some of these groups that maybe bought a deal in 21 and have a bridge loan. They were 80 levered and they either have a rate cap or they don't have a rate cap, and they have to rebuy the rate cap, or they have a maturity and they don't have any equity in the deal anymore, and they start running out of options. They don't have the ability to actually cash call. I was talking with somebody he was saying who manages some properties for a bunch of workforce housing. He was saying that one of his clients was hesitant to do a cash call, even though they needed it, because they thought they'd be put out of business if they had to do a cash call. So that's kind of the mindset of some of these syndicators that have been in the business for a little less, and I think a cash call is a hell of a lot better than losing a deal in my mind. And I think, I think that's it. So I think those problems probably show themselves up more the second half of the year and the workforce housing space. So, I mean, if you want to sell a workforce housing deal, I don't think time is your friend. If you need to go, I would go sooner than later, because I think it gets worse before it gets better from a valuation standpoint. And to James' point, I think if you can survive into 25, like he was saying, I think that's probably a long enough time horizon. But can you get through the rest of this year and the better part of next year to get through your problems in the workforce housing? That'll be seen if that's a lot of these groups are able to, that are kind of relatively new syndicated groups with not a ton of personal liquidity.
Let's talk about that, because I'll ask this question to James and to Michael these days, because it's challenging to raise money. So on the part of the general partner, Mike, how difficult is it to raise money? And then the professor, if you can just give maybe some bullet points of what you think of why people are still investing in multifamily. So Mike, how difficult is it to raise money?
Yeah, the last deal we did, we raised money in September of 22, and we got $33 million in about a month, which we had, a month plus kind of set up to that. So, but it was really, really hard, Paul. I mean, it was considerably harder. Some of the objections that we got that were maybe a little surprising, a little different than I was kind of anticipating going into it, were, a lot of these guys, one, you get general fearfulness in the market. That's when the stock market was dumping and rates are rising right in the middle of the race. So that wasn't very helpful in September, so just general fearfulness. Second was, there's an actual yield alternative out there where, for the longest time, if you didn't invest your money in stocks or a real estate deal or something like that, I mean, your alternative was, buying a bond or putting money in your money market account, and you're going to earn less than 1% yield. Now you can go buy a 2-year yield north of 4%. So there's actually alternative way to generate some yield. So if you have a real estate deal that year one is sub 4%, then you're yielding less than a risk-free rate from a treasury. So that's a pretty hard argument to overcome from a current yield standpoint. It has to be made up with tax advantages and IRR and kind of overall performance. So that's a hurdle that we have now are facing that we used to not face because the alternative yield's higher. And then finally, a lot of the people that were going to invest said, to me, listen, I'm in 5 deals that were supposed to sell this year. Only one of them sold. So if one of these deals sell, I'm looking to reinvest, but all my money's deployed. So I don't think I fully appreciated the last few years how much of the money in the space was from the velocity of deals. This deal, invested in a deal, $1 turns in, 100,000 turns in 200,000. They take that 200,000 out and they go put 100,000 in 2 different deals and kind of keep rolling and rolling. So there's been a lot of that where with the transaction volume seizing up to a large extent, like we talked about at the beginning of the podcast, that's not freeing up a bunch of capital that would then be reinvested. So I think that's a big part of it. So it's just making raising money a little bit more challenging. So, however hard, if you haven't raised money in a while, however hard you think it is, it's probably 2 to 3 times harder than you think it's going to be. You really got to work to get it done, which we did. So I think the next deal, if we go out and raise, it'll be, smaller, not larger from a check size until we get a little bit more confidence that the market's kind of calmed down and is there. But I think that's probably the opportunity at some point this year and going into next year, there'll be some opportunity that we haven't seen for, many, many years from a valuation standpoint. And I think those will be some pretty hella good buys when the activity starts picking up again.
Sounds good. James, any comments on the LP side?
Yeah, I mean, I think, I came into business in 2015 and, I think at the beginning it was maybe 50,000 hard day one, 100,000 hard day one. And we maybe saw one person lose earnest money I saw one person lose money between 2015 and like 2021, one person out of hundreds of deals. And then last year, the ability to raise equity was the number one challenge. And numerous people lost earnest money at the title, or it was sitting at the title company or it was in the seller's account already. And so that earnest money, that hard money was real last year. And that became a real issue for people in terms of their ability to raise equity because they sometimes maybe raised the amount of equity that they needed. And then the loan came in shorter than they needed it to be, right? So they had to go out and raise more equity or they had to put in some sort of preferred equity at the time to get the deal done. So a lot of deals still got done last year, but some general partners just walked away from deals. And whether that was $500,000 or $1 million in earnest money, last year, I saw more earnest money lost than at any other time. And so that's making a lot of these general partners a little bit more gun shy when putting earnest money down. I've seen a couple contracts and it's definitely a lot lighter, right? So it used to be 1 or 2% of the purchase price. Now it's half of that, or maybe a third of that. And then some of it goes hard day one. Some of it goes hard after 30 days or 60 days or never goes hard, right? So there's a financing contingency in there depending on where the deal's at. But yeah, I mean, I think there's still a huge appetite for multifamily. I mean, across the board, whether people were in the office space or retail space or hotel space, there's a lot of money still coming into multifamily just because you can, work in a lot of different places, but it's hard to sleep in a lot of different places. So I think the leases resetting annually, I think help. The reset pricing helps. And then I think there's going to be a good amount of deliveries this year. But in terms of new development, 2 or 3 years from now, there's not going to be a lot delivered. So, the lending is still available through Fannie and Freddie on existing multifamily, and there's still bonus depreciation. I think it's 80% this year instead of 100%. But yeah, I mean, when I started in the business, mostly every deal was, 10% cash on cash by year 2. And I think that's what people are going to start wanting, right? You're going to have to buy these deals at 6% or 6.5% cap rates, put 5 or 4.5% debt, and then get to a 10% cash on cash on some of this workforce housing. And that's going to reset. And that's going to bring the investors back, right? Because if your cash is sitting there making 4%, but you can go out and make, 6, 7, 8% cash on cash in multifamily, that's when they'll come back.
Different areas of Texas. Mike, you bought a property in Austin. You bought a property in the Dallas-Fort Worth area. Kind of walk me through the 4 major areas of Texas about what you like and why you like it. I mean, what's your 2 cents? And then James, maybe talk a little bit about where you're saying, expanded cap rates.
Yeah, I mean, I think right now I don't play in Houston, so I don't really have a lot of commentary there. But it seems like San Antonio is being San Antonio is kind of slow and steady and performing okay. You don't have the high highs or low lows, and it seems like it's going to benefit from some of the onshoring where a lot of the manufacturing is going to come back, or maybe even nearshoring, being close to Mexico. It's a logistical manufacturing kind of hub with some military. So, all those things seem to be, kind of in favor right now. So I think San Antonio will be ultimately the beneficiary over the next several years of that. I think, Austin is, kind of your high flying market. Housing prices there went up probably more than anywhere or certainly went up there more than anywhere else in the state. One of the higher markets, and you're starting to see some of the single family home price decline with the mortgage rates come up. So you kind of see the headlines around that, and they're building a lot of multifamily there. So we'll see if rent starts to soften. We haven't really seen that yet. But, as they deliver a lot of these deals in 23 and 24, you would think that there'll be some concessions and a little bit softening around supply pockets, which are several in the city. There's so much supply kind of coming on. So we'll see kind of how that plays out. And obviously they have a little bit more tech jobs. And if there's some tech layoffs, that might be a little more impactful to the city of Austin. But, I think from what I can tell, at least early, and I'm certainly no expert, but a lot of the tech layoffs are they're laying people off in California, or these higher income areas, and it's not impacting as the same degree in lower cost areas like the center part, like Dallas and Austin per se. And then DFW just seems to be doing pretty well economically. I don't really see a whole lot of dislocation in my day-to-day life. It's still pretty damn hard to get a reservation at a nice restaurant, and all the stores are busy. You go by North Park Mall, it's packed on a weekend every day, and so it doesn't seem like it's really come home yet. Not saying that we won't see it, but I mean, shoot, here recently there's a big announcement that they're going to build a new Universal Park up by James's backyard up in Frisco. So
I was going to say, James, is that going to have any impact with you with traffic and noise and things like that, or your boys just always want to be over there?
We'll see if it gets built. It's funny, like a lot of announcements in Frisco. There'll be a lot of prep. They'll talk to all the people who live up here and sort of get the blessing. Other deals, the developer buys the land and they just, we've got 800 acres and we got a 100-acre slot, and then Universal comes in and says we'll take it. So you never know how these deals come about, and so I don't know, delivering that right now in the next 4 or 5 years, we'll see.
And go around to some of the different cities. What's your 2 cents?
Yeah, I mean, I just pulled some stats, and I think Austin, average rent's like $1,750 compared to, let's say, Dallas of $1,550, and then Houston, San Antonio is around $1,300. So Austin definitely is a high flyer in terms of price per door. I mean, average deal size is probably $240 a door out there. So in cap rates are probably 4.5 or so. So I mean, Austin's definitely the top notch. It's going to have the most, I would say, volatility. I think some people still think Austin's this huge market, but compared to, let's say, a DFW, it's just DFW and Houston are just going to move a little bit slower in terms of, the amount of volatility. And so I think Austin and San Antonio are probably going to have a little bit more volatility than like sort of your juggernauts of DFW and Houston. But yeah, I mean, I'm still always surprised when I look at stats for Houston. I mean, average rent's like $1,350. Price per door is like $165. But yeah, you just can't compare, a B deal in DFW compared to a B deal in Houston. It's just the price per doors are just off.
All right. So before we say goodbye to everybody, last minute thoughts and things that you think people that may be getting into the business, people are currently in the business, Mike, anything that you could add to help people's lives out these days?
Yeah, I mean, I think I'll just be careful out there, right? I mean, it's going to be a little harder to raise the money right now. I think until sentiment kind of shifts. Sentiment's been a little strained relative to, certainly 20, the last 4 or 5 years up and, so sentiment started getting strained around late spring, early summer of 22. So I think raising money is a little tough. I think, debt obviously is, James alluded to it, you get a deal, you think you know what the debt is, and all of a sudden something happens and your proceeds get cut, 10% or 5% or whatever. So that has an impact on your return. So making sure you understand where your debt is and being pretty thorough about that. And, making sure kind of you understand the risk when you get a loan sizing. Where's the risk within the sizing? With the treasury, is my sizing rate set now, or can that move on me? And what are those parameters? And what does every 10 basis points of the treasury do to my loan sizing? Is that going to 10 basis points going to take $200,000 out of my loan sizing? When you start kind of breaking it down to metrics like that, or if my NOI goes down or my collections go down, what does that do to my loan sizing? It's really trying to kind of understand that market. Or if you're doing we had that little 70s deal I mentioned, we had a regional bank come drop us in the grease. They told us they're going to do a deal, and then they dropped us in the grease. So we had to re-rack the deal right before Thanksgiving, and luckily we were able to solve the problem and get it done because we're pretty resourceful and well-heeled. But if we weren't, that could have been a real problem because we had some earnest money up, and it would have been a real problem here. So just kind of making sure you understand the quality of the bank and track record. I think that the bank, your debt is still probably the biggest piece of the puzzle right now. And then and I think not being afraid, just kind of offer what you think things are worth and what makes sense to you. And you'll probably get rejected a bunch, but eventually, I think there's going to be some sort of meeting of the minds. So either the debt market's going to improve a lot, operations is going to improve a lot, which will allow you to pay more money, or the sellers are going to have to take less money to clear these deals. So, or somewhere in the middle of those two things are going to have to happen, because there's a gap right now and not that much is transacting. So there's going to be a moment in time, probably at some point in 2023, where the spread narrows and transactions start happening quite a bit more frequently.
James?
Yeah, I mean, I think for guys who are in the business already, going back to survive to 25, your job is not to become a forced seller. And I think a lot of the loans we did, probably 16, 17, 18, 19, it was sort of fixed rate Fannie Freddie. But in 20, 21, 22, a lot of that was floating rate bridge and Fannie floaters or Freddie floaters. And I think the thing that people have to understand is you need a lot more money on those deals compared to when you just have a fixed rate with, 5 years IO and 10 years fixed in the meantime. And so while you're in the deal, a lot of these deals need a lot more in terms of escrows and a lot more cash. And so you're going to have to figure that out, whether it's you're going through all your deals, as a general partner, probably go through all your deals, figure out, in 23, do I need to be doing something, right? If I have a floater, does it make sense to sort of recast it and reset that deal? Does it make sense to sell it? Does it make sense to just fix it for now and do like a step down prepay and just sort of get off the floating rate wheel for a little bit and make sure you have some capital for that deal, but then also for some of these other opportunities that might come up in terms of buying opportunities, right? So if you're dealing with all the stuff that you got in the back, trying to make sure that you survive, you're going to miss some of these opportunities that come up in terms of buying opportunities, whether it's, from bridge guys or from floaters. So just, I would say those are the two main things. And then for new guys, I mean, we talk to new guys all the time, and you've got to really set up your team correctly. So whether it's, your mortgage broker, whether it's your property management, whether it's who you're going to partner with, we've seen a lot of new people come into the space. And this is, one of the things that I always tried to figure out is like, how come there's nobody here from like 2003? Like there's a ton of guys from, who started in that Great Recession and came out, and, they're the guys that you hear of today who have 30,000 units. There's going to be some of those guys who come out of this recession who start in 23 and 24, but you've got to set up your team right. You got to have those things set up so that you're able to take down deals when nobody else can. So there's going to be opportunity though.
So the key phrase, the walkway, survive until 2025.
Yeah. Survive to 25.
I love it. Three things that we want you to promote there, James. Greg Willett again, JP Conklin, and then also talk a little bit about your YouTube channel of what you have out there that just came out again on Friday. That some people may not know that it's out there, but let's direct them to that channel. So talk about those three things.
Yeah. So February 13th, which is a Monday, that's Greg Willett. Wednesday, March 22nd is JP Conklin. And then like once a month, we'll put together just a multifamily financing webinar on YouTube. We'll spend 30 minutes going through what we're seeing in the market. So you can just type in multifamily financing, James Zhang in YouTube, and it'll pop up. But yeah, just if you're not on our email list, send us an email or fill out the contact us on the Old Capital podcast, and we'll add you to the list and you'll get those emails.
That's fantastic. Some great information that's coming out of Mr. Michael, the Governor Becker, and then James, the Professor Eng. Hoping everybody's going to do great in 2023 that's ahead of us. So again, thanks for joining us. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.